presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compac Market Wrap YouTube weekly update for April the 21st, 2025. I'm Mo Ansari, President of Compac Asset Management, and thank you for joining me today. First of all, I want to remind all of you, all you have to do is click on the subscribe button, so whenever I post a YouTube update, you will be notified and you can watch it at your convenience. Looking at the numbers, last week we stabilized a little bit, but again, negative for the week. S&P was down 1.49% on the week. We saw the Dow down 2.66% for the week, and the NASDAQ down 2.62% for the week. Year to date, S&P is down now about 10%. Today we are having a terrible day in the market again. The president said Powell needs to bring interest rates down, and Powell said he doesn't want to do that. So it is creating some uncertainty and some more anxiety in the market, and markets are down dramatically this morning. Again, but still way above the lows that we set a couple of weeks ago, where we were down to 48.35 for the S&P. We're trading around 5,100. I'll take a look at the charts and what they're trying to say. As I've talked about, it seems like we're in the fourth wave in the Elliott wave, which are usually choppy. We go back and forth until we get some resolution. I'll talk about that in a minute. Last week, real estate was the best performing sector. The worst performing sector continues to be technology. And the S&P, as I mentioned, down about 9.8% or close to 10% for the year now, depending on what your asset allocation is. Again, we've talked about how important it is to have that asset allocation correctly. If you're down 4, 5, 6% for the year, it hurts. It never does. But after 2 fabulous years, that is okay. If you're down 20, 30%, you have a problem. Obviously, you know that you're trying to hit the home runs, and that's when you strike out. But in financial matters, when you strike out, it's very hard to come back. It takes a long, long time. If you lose 50% of your money, now you've got to get 100% return to get back to where you were. And that is why we have talked about having the correct asset allocation since the beginning of the year. You're uncomfortable with your position, because if we do go into a recession, and the chances of those continue to go higher, the market is down. It's down 10%, the S&P for the year. But it's not a bear market yet. That's 20%. And if it becomes anything worse than that, then you have to be prepared to make sure that you have the correct asset allocation to handle the downside when it comes, if it does. Oil continues to go down as the global economy. The expectations are that the global economy is going to continue to slow down because of the tariffs. We are going to get some kind of relief once the negotiations are done. But it takes time. Even with one of our closest allies, Japan, they've been here for a week, but there's no trade deal done yet. It takes time to get these deals done. As I've said, the biggest deals that we need to do is the European Union, Japan, Korea, India, and obviously China. China, I think, can be separated from all of our allies. If we can get the allies on one side, on our side, and they don't go over to China, which is trying to get them to make deals with them rather than with us. So that is going to see how this whole thing shakes out. And then it depends on the Fed. As Chairman Powell said last week, that tariffs could cause inflation and increase the chances that the economy is going to slow. We don't know by how much, and we don't know how long the tariffs are going to last, if they are going to last, or if they're going to be permanent. So no one knows at this point, and that is what is causing these gyrations in the stock market at this point in time. And the one thing that we are starting to see is interest rates usually go down. Bond market usually goes up as the stock market comes down in uncertainty. People run to the U.S. bond market for safety. But this time around, they're not buying U.S. bonds, but they are sort of sitting on their hands and waiting to see what happens. And that is the linchpin of the global economic system, is the U.S. bond market. If the bond market starts to get nervous, then it is many times larger than the stock market. There's much more money that is in the bond market, and that could shake the foundations of the economic system. So that is what people are concerned about. I think we are going to work through this. It's going to take time, and during that time, we're going to see a lot of volatility in the stock market. So you need to make sure that your portfolio is in a position that you feel comfortable. If the market does continue to decline, if we do go into a bear market, we do go into a recession, are you going to handle that? Have you asked that question? Or are you just hoping that things are going to get better? As I've said for the last 40 years that you've heard me on the radio, that hope is not a good strategy as far as financial markets are concerned. But at the same time, you don't want to be out of the stock market totally, because you look at the earnings estimates for the current year, I still feel they're way up at this point, and they are going to continue to come down. Economic numbers, retail sales rose 1.4%, housing starts came in at 1.3%, industrials, we got not a lot of economic data coming out this week. One thing that we are going to take a look at, we talked about that, is what happens over a period of time. How long will it take us to get from where we are now to some stability and get some certainty? I believe that it'll be another 2 or 3 months before we get to that point where we see the stability and we get some clarity on tariffs, on interest rates, on policy as far as economic policy is concerned. Looking at the technicals, we made everything moves in 5 waves. Once we see this was wave 1 up, 2 down, 3 up, 4 down, and 5 up. Once we see 5, that is usually marks a top in the market, and that's what we saw. Now we've started a wave count to the downside. This is wave 1, wave 2 back up, and wave 3 to the downside. It looks like we came back up, tested the 20-day moving average last week, kissed it a couple of times, and that could be wave 4. And then we start wave 5 to the downside. Right now we've used up a lot of downside energy, so the target below, usually the 5th wave gets below the 3rd wave, which was 48.35. That was this low right here. If we come and make a 5th wave low, targets right now around 4,700, and 48.34 was the last 35. 48.35 was this low right here. So if we do get below 35, I think we can marginally nix it if we do get some resolution. If we don't get some resolution, then we could see an extension of the 3rd wave. This would not be 3, and we go down again, and wave 3 comes down here, then we see a wave 4 up and the 5 further down. It just depends. Again, no one knows right now which way this economic picture is going to go. That is why having the correct asset allocation now is the most critical thing in your portfolio, to make sure you have the right mix of assets and you can handle any volatility in the market. Looking at the long term, these are weekly charts going back to 2021. This is 21, 2021. This is 22. This is 23. This is 24 right here. Now we're in 2025. So each one of these vertical lines is 1 week of trading. You can see we were wave 1 to the upside, 2 down, 3 up, right up to here, 4 down. Seems like we've completed wave 4, but staying above this number, 51.78, is critical. We're trading around 51.15 right now. 4th waves, as I've mentioned, are choppy. They'll go back and forth, and I think we're going to stay somewhere in this range, somewhere around here to here, which is around 5,400 to 4,800, maybe somewhere around there. If we break 4,800, then things get a little bit nervous. Here's the next support area, which is around 4,600, and then obviously this low that we made in October of 2023, which was around 4,100 plus or minus. So those are the numbers that we're looking at, but that 4,100 is 1,000 points below where we are now, or about another 20% below where we are now. That would be a major bear market. That is if we go into a recession, if the economy slows down, if we continue to see uncertainty on tariffs and uncertainty on what happens overall with the economy. No one knows the answer to that one tweet, as we saw a couple of weeks ago, when the market went up 3,000 points as soon as the president paused the tariffs for 90 days. we could see a reversal in tariffs, we could declare victory and go home, and that would be the end of everything as far as the tariffs are concerned. And then I think the focus will shift towards the budget talk and tax cuts to stimulate the economy, which would be wonderful to get tax cuts, but we need to make sure that we do not do tax cuts at the expense of the deficit, where we just print money and give it out to people. That will be inflationary in the long term, and the bond market, I don't think, will take very kindly to that, and that'll push up interest rates also. So there's a lot of uncertainty right now, so we'll see where we go from there. NASDAQ seems like it's completed a fifth wave. I'm not quite sure that we've completed wave 5. Came back up last week, tested the 20-day moving average. Now we've broken down again. We're down about 3.5% today as I'm doing this update. Also, the dot plot is negative, where these dots are above the market, which is a bearish sign. Critical support is around 14.6, which is the 200-week moving average. We came and tested that a couple of weeks ago, bounced off of it. Now we're bouncing around. But again, this is wave 4. Wave 4s are messy. They go up and down before we resolve, usually to the upside. But we'll have to wait. A lot of this depends on what could be, and I talked about this a lot more in our webinar that I did last week, where do we have a structural bear market, there are cyclical bear markets, and there are event-driven bear markets. And I showed all the analysis of each one of those going back about 100 years, how each bear market has played out if we are going into a bear market, and what are the outcomes, how long they last, how much they go down usually, and how long it takes for them to come back to their highs. I still think we're in an event-driven market, which could turn into a cyclical bear if we get into more of a situation where we have a prolonged uncertainty in the market. So we'll have to wait and see. Interest rates also starting to go up. They're up about 6 basis points today, 4.39. Usually stock market goes down, interest rates come down. This time around, interest rates are going up, which is a slowing economy and higher interest rates. What the interest rate market is saying, that we are going to see more inflation. And that is the definition of where we get a stagnant economy and inflation together, and it's called stagflation. Last time we saw that was with Jimmy Carter in the 70s. Are we going to get that? I don't know. So it just depends how quickly we resolve all of this. So that's where we are right now. The markets are choppy. Having the right allocation, having the triad of defense mechanisms built into your portfolio is critical. If you do not have those, give us a call. We'll be more than happy to help. All you have to do is dial 800-388-9700. We'll sit down with you. We'll develop a plan for you. But don't wait. If you're down 30-40%, then at this point, there's nothing more that you can do instead of hold and hope. You heard me say this in 2000, that a lot of you become hold and hopers, where you're holding and hoping one day you're going to break even. That is the worst position to get into, where you just say, forget it. I don't want to look at it anymore. I'm down so much. Whatever. That's not the way to look at your financial future. You have to make sure you have a strategy to deal with the bull markets. Last couple of years have been wonderful. You're down 5-6%. So you want to make sure you have the right mix of assets now if we do get a correction or a bear market, and you can handle that and be ready for the next leg up. Everything goes through cycles. Make sure you're there. And if you're trying to hit the home run, you're down 30-40%, then you had too much risk in your portfolio. Give us a call. We'll be more than happy to help. 800-388-9700, 800-388-9700, or send me an email at invest@compact.com. We'll sit down with you. We'll develop a plan for you, and it is all free to get you going in the right direction. But you have to get it done at this point in time. Looking at the weeklies, small caps, definitely not looking very good. Gold is one of the big beneficiaries, where we have seen the uncertainty with people getting nervous with the dollar, getting nervous with the stock market, not going to the bond market for safety, but rather going to gold. Gold is up about $109 an ounce today, hitting a new all-time high of 34.37 as last trade. It hit 34.42 today as a high. So this was looking like a fifth wave top, but it seems like we've got an extension of the third wave now, and this is wave 3. It was looking like 5 right here, but that has been X'd out with the new rally that we've seen in gold, and it is parabolic now, which is straight up, which is usually the end of the market, but it is moving so quickly right now. There's a lot of momentum to the upside in the gold market. Again, if you want these YouTube's update delivered directly to you, make sure you subscribe to this channel. Do it now so you'll get an update. Whenever I post an update, you'll be notified. Again, if you're nervous with your portfolios and you're not comfortable with your allocation, call us. Do it now, 800-388-9700, or just send an email to invest@compact.com. Invest@compact.com. We will sit down with you, develop a plan for you, show you how much risk, what you're trying to accomplish, how old you are, emotionally what is your risk profile, and then match that all up to see what is the right mix of assets for you to get you from where you are now to where you want to go financially. So make sure you give us a call or send us an email. Those are my thoughts. Those are my observations. If you make sure you stay tuned to this channel, I'll be updating, doing the podcast with Javed, which is a much more detailed version of this, but it doesn't have the visual charts like this YouTube update does. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.